Welcome back to another video. Let's cut to the chase. To turn $100 into $1,000 or more, you can consider the following options. Number 1. Investing. Investing your money in the stock market or other investment vehicles such as mutual funds or exchange-traded funds, ETFs, can be a way to potentially grow your money over time. When you invest, you're buying ownership in a company or a basket of companies, and as the value of these companies increase, so too can the value of your investment. However, it's important to understand that investing always carries some level of risk and there's no guarantee of profit. It's recommended to diversify your investments, invest for a long term, and be prepared to weather short-term market fluctuations. Diversifying your investments in the stock market is a key part of managing risk and potentially reducing the impact of market volatility on your portfolio. Here are some ways to diversify your investments. Invest in a mix of different asset classes such as stocks, bonds, real estate, and commodities. This can help spread risk across different markets and reduce the impact of any single market downturn. Diversifying across different sectors of the economy such as technology, healthcare, energy, and consumer goods will help reduce the impact of any single sector crash. Moreover, consider investing in companies based in different countries and regions. This can help reduce the impact of any single country or region downturn. Also consider to invest in both growth and value stocks. Growth stocks are companies that are expected to grow rapidly, while value stocks are companies that are undervalued by the market and may potentially offer higher returns. Don't put all your eggs in one basket. Invest in a mix of different individual stocks rather than heavily concentrating on just a few. Number 2. Robo-advisor services. A robo-advisor is a type of online investment service that uses algorithms to manage your investments for you. It uses automated technology to help you invest in a diversified portfolio of low-cost exchange-traded funds based on your financial goals, risk tolerance, and other factors. Robo-advisors are a relatively new innovation in the world of investing, having emerged in the early 2010s. They have grown in popularity in recent years as technology has advanced and more people have become more comfortable with the idea of using automation for financial services. However, while the robo-advisor concept is relatively new, the underlying principles of automated algorithm-driven investing have been around for decades. The use of algorithms and mathematical models to make investment decisions has been a common practice in the financial industry for a long time. And robo-advisors simply bring this type of technology to a wider audience by making it more accessible and affordable. Here's how it works. You provide information about your financial goals, risk tolerance, and other factors, and the robo-advisor uses this information to recommend a diversified investment portfolio tailored to your needs. The robo-advisor then automatically buys and sells assets in your portfolio to maintain the target allocation and manage risk. Robo-advisors typically charge lower fees than traditional human financial advisors, making them a more cost-effective option for many investors. Robo-advisors are typically easy to use, and you can access your account and monitor your investments online at any time. On top of this, robo-advisors use algorithms to build diversified portfolios that are tailored to your financial goals and risk tolerance, which can help manage risk and potentially maximize returns. Moreover, robo-advisors automatically rebalance your portfolio and make investment decisions for you, which can be convenient for busy investors or those who are new to investing. That being said, it's important to note that robo-advisors are not a one-size-fits-all solution and may not be the best choice for everyone. Before investing with a robo-advisor, consider your financial goals, risk tolerance, and other factors to determine whether this type of service is right for you. Number 3. High-yield savings accounts. High-yield savings accounts are a type of deposit account offered by banks and other financial institutions. They are designed to provide a higher interest rate than a traditional savings account, allowing you to earn more on your deposits. High-yield savings accounts are insured by the Federal Deposit Insurance Corporation, or FDIC, meaning that your deposits are insured up to $250,000 in the event of a bank failure. This makes high-yield savings accounts a relatively low-risk investment compared to individual stocks, which can be volatile and unpredictable. The interest rate on a high-yield savings account is guaranteed, which means you know exactly how much you will earn on your deposit. With individual stocks, there is no guarantee of a return, and the value of your investment can go up or down based on market conditions and the performance of the underlying company. High-yield savings accounts are easy to set up and manage, making them a convenient option for investors who don't have the time or expertise to actively manage a stock portfolio. High-yield savings accounts provide quick access to your funds, allowing you to easily withdraw your money if you need it. With individual stocks, it can take time to sell your shares and access your funds. That being said, it's worth noting that high-yield savings accounts typically offer lower returns compared to other investment options, such as stocks or bonds. So while high-yield savings accounts can be a good choice for people who prioritize safety and stability over maximum returns, they may not be the best option for investors looking for higher returns or who are willing to take on more risk. Number 4. Micro-investing apps. Micro-investing apps are mobile applications that allow users to invest small amounts of money, often in fractional shares of stocks or exchange-traded funds. These apps are designed to make investing accessible to people who might not have a lot of money to invest, or who might not be familiar with the stock market. Some micro-investing apps use other types of investment products, such as mutual funds, to allow users to invest their money. The way micro-investing apps works is by allowing users to invest in a variety of investments, such as stocks, exchange-traded funds, and mutual funds. Some of these apps even use algorithms to automatically invest users' money based on their financial goals and risk tolerance. One of the benefits of using a micro-investing app is that it provides a simple and accessible way for people to start investing, without requiring a lot of money or investment knowledge. Additionally, some of these apps provide educational resources and tools to help understand the stock market and make informed investment decisions. Another benefit of using a micro-investing app is that it can be a low-cost way to enter into investing, as many of these apps do not charge high fees like traditional brokers or mutual fund companies. This makes it possible for users to keep more of their investment returns, allowing their money to grow faster. Overall, micro-investing apps are a great way for people to start investing small amounts of money, build wealth over time, and gain exposure to a variety of investments, including stocks, ETFs, and mutual funds. Number 5. CD laddering. CD laddering is a strategy used to invest in certificates of deposit, CDs, with a goal of maximizing returns while maintaining flexibility and liquidity. Here's how it works. Instead of investing a lump sum into a single CD with a long maturity, the investor splits the investments into several CDs with different maturity dates. For example, an investor might put $100 each into CDs with maturities of 1 year, 2 years, 3 years, and so on. The idea behind CD laddering is to take advantage of higher interest rates offered by long-term CDs while still retaining access to some of the invested funds. For example, when the 1-year CD matures, the investor can either reinvest the funds into another long-term CD or access the funds for other purposes. In this way, the investor benefits from the higher interest rates offered by longer-term CDs while still retaining the ability to access some of the invested funds in the short term. Additionally, by investing in CDs with different maturity dates, the investor can spread the risk of interest rate fluctuations, as they will be able to take advantage of rising rates as they invest in longer-term CDs over time. CD laddering is considered a low-risk investment option, as CDs are insured by the Federal Deposit Insurance Corporation, up to $250,000 per depositor per institution. However, it is important to note that while CDs are generally considered low risk, they are not risk-free. The interest rate on a CD is fixed, and if the interest rates rise, the investor may not be able to take advantage of higher returns offered by other investment options. You can start investing in CDs by following these steps. Research different financial institutions. Look for banks or credit unions that offer CDs and compare their interest rates, fees, and terms. Determine your investment goals. Decide how much you want to invest and what your investment timeline is. This will help you determine which CD terms are best for you. Open a CD account. Once you've selected a financial institution, you'll need to open a CD account. This typically involves filling out an application and providing your personal and financial information. Fund the account. You'll need to deposit the funds you want to invest into your CD account. You may be able to do this by transferring funds from another account or by mailing in a check. Wait for the CD to mature. The funds in your CD account will be locked in for the term of the CD, typically ranging from 3 months to 5 years. Reinvest or withdraw the funds. When the CD matures, you'll have the option to either withdraw the funds or reinvest them into another CD. Laddering is a great investment strategy for a variety of reasons. First, laddering helps protect investors from major stock market downturns. When the stock market goes down, it can be hard for average people to get their money back out of their investments quickly and without penalty. However, investors who are laddering can help spread their investment over a series of smaller purchases so that they don't lose as much money in case of a downturn. Secondly, laddering allows investors to slowly build up their wealth over time. This means that they won't exhaust their funds as quickly and they'll always have the option to invest more if they want. And finally, laddering provides investors with an opportunity to grow their money at a manageable pace. Rather than investing all of their money at once in something risky like stocks, laddering gives them the chance to grow their money slowly but steadily over time. It's important to carefully review the terms and conditions of each CD before investing, including the interest rate, maturity date, and any early withdrawal penalties. Additionally, it's a good idea to regularly monitor the performance of your CD investments and make any necessary adjustments to your portfolio to ensure it aligns with your investment goals. Please keep in mind that these investment options come with varying levels of risks, and the best investment strategy for you will depend on your personal financial situation, goals, and risk tolerance. Consider consulting with a financial advisor to help you determine the right mix of investments for your needs.